In the news, commercial lending's collapsing. The latest data from Goldman Sachs is showing about CMBS issues for the first quarter, lowest level since 2010. Banks reducing the amount of leverage, LTV ratios. And then we've seen an increasing share of banks reporting tighter lending conditions during the last 2 weeks of March with their Federal Reserve filings. So that's the news. What are we thinking, and what are we actually seeing in the market as we're talking to banks and whatnot?
You're raising your hand. You're it.
I
Yeah,
am.
you're tagged.
Well, I was a lender for a Wall Street firm during the 08-09 collapse. It was a Wall Street firm. It was GMAC Commercial Mortgage. It's not one of the big five that you've heard of that's like the most famous one, but I mean they were off Wall Street. This is eerily similar to what we saw at that time. So when I was a lender, I got a call one day in like March or April of 2008 and was told, no more loans. I go, what do you mean, no more loans? That's what our business is. What are we going to do? Sit around and, watch TV all day? And I probably didn't say TV, but the point was, I said, look, unless it's a relationship that has 5 or 10 loans that we've done and that you know personally very well and is a big shot, we're closed for business. And at that point, we had seen tightening the same way that we're seeing it now, is almost 500 basis points in the same amount of time, and we closed the market. That's what we're seeing. Jeff and
That's
I.
That's actually what we were just told.
Yep.
We got in just before from one of our lenders before they closed down and said, no, we're going to move your we like you. We're going to move your application forward. But if you guys change the structure or if you do anything else, you're out. We're only lending to our known entities, people we want to deal with.
Yeah, it really does seem. It seems like.
Go ahead. I'm sorry. I apologize.
I'm gonna have another sip. Go ahead, Zach.
Well, this is what happens when we get together. What we're seeing is the yield constant that we have to underwrite in a deal is crushing prices. And so closing for business is basically stagnating real estate to the point where you're not going to see any transaction.
Yeah, what I was going to say is it really seems that things were tight a few weeks ago, but it seems like there's been a noticeable thing, things even tightening more. Like you were saying, even almost seeming like they're going to a point where you just can't get the loans at this point.
Well, I mean, I think if you add the constant that we're aware of, which is potential bank failure, run on deposits, you have banks that are scared of that. You have banks that are scared that their portfolio that they've lent on could be potentially underwater. If you remember, there was 3 years ago, 5 years ago, 7 years ago, you were looking at loans that had just been outstanding that are now coming due, that were priced wildly under what they could be right now. So if I'm a bank, I could appreciate the side if I'm having to deal with tier 1 liquidity and how I'm going to lend or how I'm going to keep my bank afloat. I'm scared to lend.
Raise my hand again.
There.
I've got a lot to say about this because there was an article that came out this morning, unrelated to what you just said, but completely related. And Jeff hit the nail on the head: liquidity.
Yep.
So the Fed's liquidity with this debt ceiling crisis is exacerbating the situation. Their liquidity is down to less than 50 billion, right? And it normally is around 500 billion. If the debt ceiling is raised, which we all want it to be, so there's not a greater catastrophe, they're going to suck so much liquidity out of this market overnight that any lender that's still in this market is going to be out of this market instantly.
Yeah. Well, I think also you got kind of what Jeff was also alluding to is you got two other issues going on here too. Of one, you got a lot of banks that are worried about a run, worried about depositors going. I mean, and there's a couple different things driving that. One is the too big to fail. I mean, if you're at a mega bank, you don't really have to worry about Chase going out of business because the government will do whatever they can. But if you're a small or regional bank, they got to worry about those depositors going to a too big to fail bank. then you've also got the fact that some of them didn't manage their duration risk well, so they really can't offer the same interest rates you could get with T-bills, or maybe you move money to a brokerage and you get it short-term money funds or whatever. But you got that risk of people, going for yield, but by leaving them.
Sorry,
Right.
What are you laughing
I'm
at, Jeff?
Yeah.
I'm laughing because I mean this of no disrespect. You're saying things that even I understand what they mean. But I think in layman's terms, what you mean, you people who didn't actually, people who were investing that weren't weighing the risk, not even considering the fact that while we're going through a potential downturn, I was fortunate enough in my banking career to not just create a stress test policy, but design the template that it did it. And when you actually look at it, I scheduled and I created that template based off of if 5%, if you had loan loss of 5%, 10%, 20%, 30%, at what point are you no longer able to be even a bank? When you add the fear of, did I invest my money right, compounded with the fear of, oh my God, if all these loans fail, or they've got to be short sold, or what are we going to do? How are we going to do it? How do we survive?
Yeah, and I think that the other thing I was going to get to is that loan
You were
issue
a
of.
banker?
No, no.
But yeah, what I was going to say is to the loan issue, you don't need the entire commercial real estate market to have problems. It is just enough that some downtown office markets are having problems. That's enough to put some of these loan portfolios at enough risk, especially when you compound it with the risk of a run on your depositors, to get a lot of these banks to just basically say we're closing shop. We don't want to issue more loans, and I think we're kind of worried that that's what we're seeing right now.
Well, I think it's even one step further, not to get really too deep into the weeds, is, banks have outside auditors, they've got, regulators, I mean, that are trying to watch and tell them everything that they should and shouldn't be doing. And the irony of it is, and of no offense to the FDIC or any of the rest of them, coming and telling people how to lend on products that they should be lending on, when in reality, the FDIC comes and says, well, holy crap, we had a pandemic. Why are you lending on office? Well, depends upon, like, to your point, what market are we in? Where's the property? What type of office property? It gets drilled down so far that, at some point banks are just inundated by crap that they just can't overcome. And that fear alone is crazy.
That's an important point, adding to this segment, because I know we're going to talk about a few others. So what do you do?
Yeah.
Right? Because at this point, office lending, we can tell you, is dead. There's not an office loan to be found. If you're going to find one, it's going to be some 15 or 20% interest rate, hard money loan that you're never going to survive. Multifamily is struggling. Industrial is struggling. So what do you do? What we have found at this point is you have to find and uncover these overlooked markets with strong trending demographics, i.e., massive migration and development dollars pouring in. For example, our Savannah property is right down the road from the Gold Star development deal that was highlighted in every major publication this week, right near the Hyundai development battery plant that they're building to supply the entire United States. And that market is booming. And we actually have Hyundai
headquarters.
And we have Hyundai as a tenant. So,
Yeah.
We went out and we locked down our office property to ride out the next 2 years, being in the market that we were in and targeting the tenant that we had to target. Because outside of that, you're kind of dead in the water.
And the irony is, we're still finding that, we're getting increased activity because of people that are trying to be, third-party affiliate distributors, or, et cetera, for Hyundai. So yeah, I mean, I agree with that sentiment as well. You're not trying to find the diamond in the rough. You're just trying to find the right demographics of where people are moving, what people are doing.
Yeah.
We've had a lot of success with that.
Yeah. I think, and we'll move on here pretty soon, but I think the big challenge we're seeing is it's always challenging to find good properties. But we're finding those. It's becoming an increasing challenge to get the financing for them as we speak today.
Well, I think it's increasingly difficult to not just find good properties, but find people that aren't willing to sell you a pipe dream. We're looking at stuff, very conservatively and underwriting it very conservatively because we don't want to just survive a downturn. We want to excel through it and do it based off real metrics, not a target IRR or target ROI that's 10 basis points apart, a 10
guys,
to a 20. How does that make
we're
sense?
we're not selling anything here.
No,
Obviously we're
I'm
selling.
not
Look, I
trying
mean,
to.
we look great, so don't worry about it. But we sell ourselves. In terms of the lending, and that's kind of where it all ties in, is finding these markets and these properties where you actually have a fundamental basis to buy a deal.
Sure.
There is still a lender out there for that. The terms aren't great, but that does still exist. It's just finding a needle in a needle stack at this point.
Maybe
Yeah,
maybe a needle seller and a needle seller stack instead. Realistic sellers. Guys
There's a
who
lot of
aren't
needles.
still trying to sell four caps.
okay.
Yeah.
Well, and some more bright news out there. At least journalists always, right, like if it bleeds, it sells. Anyhow, home prices posted big declines. Median U.S. home sale price fell over 4% year over year in April. Austin and Boise prices are $80,000 less than a year ago. And this is really this story is really focused on kind of pandemic boom towns, the coastal markets. But wanted to kind of talk to that a little bit because I think as much as these news stories are kind of alarmist, prices got pretty high, especially in some of the markets that we're talking about. So far, what we're talking about it's not 2008. So far, what we're talking about is really kind of a bit of a pullback to some pretty crazy levels.
For sure. I can tell you specifically in the surrounding area in Florida that I'm at. I watch it. I've got a property management company where we review rental rates, we review property prices, et cetera. And I don't think there was any other option but for prices to come down, commensurate with the financing rates that are out there.
Yeah, I mean, I think that's really the big point here is your mortgage rates go up, you can buy less house. All right. I mean, so
God, that's the perfect example. I'm laughing because my real estate agent over there is he's the one out there telling me to come full time to Florida because right now I'm only part time, like 7-8 months, and I've been telling him find me a house. But now you might actually be able to.
Well, it's just a matter of whether or not your significant other is gonna love it.
I heard there's no, I'm not going to finish that.
That's probably
a
good idea.
There's probably great areas to move into Florida that families will thrive into. But to your point, Steve, the about a house and how much less you can afford. I can tell you that the house next door to a property I own sold for half of the price of the house that I own, and their mortgage payment is 10% higher than the mortgage payment that I have. So there is going to be, and there is a movement in the prices, and it is pretty dramatic and it's pretty serious what's going on. So I don't know that we've seen the worst of it, but I think that, like you said, it will be more isolated to the boom towns as opposed to, markets that have fundamentals that didn't see a crazy run up for no reason.
Yeah, and I think go on, Jeff.
I was gonna say, it's actually interesting to kind of that point. It made me think about something. Theoretically, we've discussed time and time again the prospect of a $500,000 mortgage at 3% compared to a $300,000 mortgage at 6%. What that cost is, and theoretically, at that time point, it gave validation for renters, landlords to rent at a higher rate because people were able to buy at higher amounts, blah blah blah. But since that time, and those prices have been drawing down in terms of the sales prices or list prices, nothing has happened to the actual rental rate prices. In this area alone, you can you can still barely find anything under $2,000 a month. Mostly everything is, for a house, even a 2-bedroom, 1-bath apartment, is $2,500 to $3,000. And theoretically, if you're at that same price, at 500 at 3%, or 300 at 6%, you're still roughly the same monthly cost. So I don't think it's done much to the landlord's mentality, other than we're going to stick with where we are, and
Well,
come
tell
rent
that to
from us.
Blackstone.
What's
Tell
that?
tell that to Kettler. Tell that to Blackstone. Tell it to some of the big boys who those Class A properties. They're even if the rates haven't come down, the velocity has declined a bunch.
Sure.
At this point, in terms of qualified applicants, it's rough out there. I don't know how to turn a rosy picture from this, Steve. I mean, you've got such lovely topics to discuss today. I feel really good about myself right now.
We're just covering what's in the news.
I feel like I punched myself in the gut.
Well, hey, it gets even better.
Yay.
So, Elon Musk just tweeted, commercial real estate's in a meltdown and home prices are going to follow. I think it's a great tweet. It definitely gets attention. I'm not necessarily ready to buy the entire commercial real estate market's melting down and home prices are headed for a meltdown either. But I think it's a great tweet.
Well, look, I mean, there might be one person that ever sees this segment, and she might have a feeling about my feeling about anything. So I'm just going to leave it there. But was there any data to support that, or was it a gut feeling? Uh-oh.
Oh no.
He's having
not a lot
seizure.
of room in tweets for a lot of data. Definitely more of a gut feel.
Okay, so Steve's back. His face isn't back. Oh, there it is.
There he is.
All right.
There you go.
That was
Sorry.
beautiful.
Yeah.
Feeling.
Elon didn't. Yeah.
Are you going with your gut feeling, or are you going with are you going with some other feeling here?
Me?
Yeah, you.
I was going to say, without any empirical data, which we all have that same gut feeling, I think he's just fanning the flames. And it's kind of more of a self-fulfilling prophecy than I think that anything that should be substantiated and worried about. So if you're going to do something and say something like that, you're moving markets, with your tweets and 150 million followers more than you're doing anything else. Show me something that's showing that. I mean, we talk about loans not being out there, but there are people still working, and there are things that are still happening in this market. So I'm the biggest proponent.
It's kind of interesting. You just
I think
caused me
it's
to think
self-serving.
Well, I was going to say, I was actually going to go maybe the opposite way. Is it really self-serving? Because
Yes,
theoretically,
he wanted to stop paying rent on his properties.
You're right. You are right there.
Scare everybody.
I didn't consider that, but maybe the unintended consequences. And actually, as I'm looking at it, maybe he actually has the timing wrong, because if we're seeing house values fall, you're likely going to which is interesting, because I'm trying to think historically, did house prices fall first or did commercial fall first? And I don't really remember that.
2009, it was houses.
Yeah. And what's interesting is it was for different reasons, but I actually, it's interesting that home values have declined quicker than commercial. I don't think you really see the commercial real estate market melt down, whatever that means empirically to him. I don't know, but I think the hardest part for people to overcome, not to be gloom and doom, is how the hell do you go from 3% to 6% on a property that you can't sell to get out of it, and now you've got to refinance and you can't afford your debt?
No, you can't. He's not wrong, and I think we all agree that he's not wrong. I think the biggest thing is fanning a flame.
Yeah.
Again, my opinion seemed more like fanning a flame. Where's the data to back it up? You're saying this, and I've had people say 50%, 80%, whatever, and they have a reason for that. There's no reason here. It's just, I'm throwing this against the wall. I'm going to see what happens, and I know it's going to make a change somewhere because I know how influential I am. I think it's a calculated move to help him with his lawsuits for not paying rent on like 6 of his properties. Honestly, that's what I truly think is happening here.
You know,
Well,
I didn't consider that.
I don't know. I mean, I'm in Silicon Valley right now. I know Elon spends time in more than just Silicon Valley, but to me, it just seems more of a statement that's focused on just a few areas, right? Because if you look at downtown San Francisco, you can make a strong argument for a pretty doom and gloom scenario there. And if you look at a regional bank that has a lot of exposure to certain downtown office markets, you can make a pretty strong doom and gloom. I
Of
just think he's
course.
lumping in. I think he's just lumping in too much. But if you look at just San Francisco, I mean, which is just absolutely imploding, the office market there, or you could look at markets like Portland or LA that
New
aren't doing
York.
that bad, but you're still having major institutional groups take those downtown office properties and just essentially walk away from them. Say, hey, you Mr. Banker, either restructure that loan on terms we want, or you can have the property.
Well, look,
Um,
you're not wrong, but look at the other side of the country. Washington D.C. is doing okay, right? Miami is hot. Some of the markets in Texas are also hot. And if I mean, I don't know if we share a screen and kind of look up a couple things right now, it's probably not worth it. But one of the headlines that I saw recently was one of the tech companies signed like 100,000 square feet of new space
There are a couple of them.
on the East Coast. Just
yeah,
because they're not in San Francisco doesn't mean that they're not moving over and signing space. I mean, office, everyone said retail was going to die and Mr. Bezos was going to put us all out of business. And to a certain degree, that did happen. However, online sales, somewhere around 13% of all sales. Retail kind of went through a renaissance. We got rid of some of the bad ones, and now you have an experience that people want. There's more brick and mortars opening than there are closing at this point. I think you're in the same place with office. I think the tweet is kind of misplaced, and it just there's not enough to back it up for
yeah,
me
that's kind
anyway.
of my exact point is that there are definitely some pockets that have real problems. They're going to create some real problems for some entities. But the broad market's not in a meltdown. The broad market's not anything close to a meltdown. And some sectors and some metros are doing pretty well. And I guess that's where also I'd go back to this is a completely different animal than what you had back in like '08. I mean, what you had back then was really this, not just US, but it was Spain, it was other countries, just this mania that went into a lot of bad debt, a lot of bad properties, a lot of bad speculation. We're not sitting on that right now. We are sitting on a few downtown offices having a real problem that's probably going to hurt people, but we're not looking at a mania that spans multiple sectors, multiple segments, multiple geographies. I'm just not seeing it. And in terms of the house prices too, I think one of the biggest things you're going to just see is people that have an existing house with an existing fixed rate mortgage. A lot of them just aren't going to move. It's not the same thing as a flipper that can't can't, continue to pay his debt or whatnot, that has to dump the property because he's got like seven of them with, and he can't, handle financing, and he just has to drop those in the market. I just don't see the setup for a meltdown
Maybe I'm
again
just the naysayer
everywhere.
for today. Steve. See, here's my problem. Is that I don't generally like to say, it's kind of like the idea of, text coming, the old way is the best way. I don't want to, keep up with times. The problem is that all those people who had those low interest rate mortgages, you're right, um, they may not want to refinance. They may not be able to refinance, but the other side is they have all this other debt. They've got credit card debt. They've got car payments. They've got all this other stuff they've accumulated because their house was so low. And let's just say they did within the last 6-12 months, they went, ah, shit, I can just refinance in a few months and I'll be good. Well, 3% just turned to 6%, if not 6.5%. And now they can't do anything. So
Well,
you're kind of back to where you were before. It's not everybody. It's not exactly what it was before, where you had, no offense to taxi cab drivers, but taxi cab drivers getting, $1 million to $2 million mortgage and flipping a property
well,
in 30
we
days.
just lost all the taxi cab drivers that were watching this feed. So
Yeah, I mean, I think we're all in agreement. There's some stuff to worry about, but I'm just arguing it's a great tweet. It's just overblown. I mean,
Oh yeah.
it's it's not all sunshine and rainbows ahead, but I'm not seeing us sliding into the black abyss. I mean, it's just but there's definitely some downtown office markets. We never participated in. I mean, we were participating in Miami, which has done great. We like, Savannah, the Charleston area, we like, which has done great. And quite frankly, I mean, this is a topic for another time. But I think there's a reason that some downtown offices that have pretty bad public policies, and San Francisco is right up there. People just don't want to be stepping over hypodermic needles and human feces as they're paying some of the highest rents in the country. Not when you can go to San Jose or Palo Alto or somewhere else in the valley. So, I don't think it's a coincidence. Like
Where
some of the
where are you
markets,
sitting right now, Steve?
I'm not an SF. I'm outside of San Jose. No
So
hypodermic
when you're
needles or
so when you step
It's
out of
easy
your
for you to
office,
sit
are
up
you
on
stepping
your
into feces?
it's easy for you to sit up on your pedestal and look down on all those people in the city, isn't it?
that everybody's moved to the pedestal. That's the problem for
That's
San Francisco, and
kind of
it's
what we're saying.
some of the most
Great
beautiful
sidewalk.
real estate in the world. I mean, if they could just clean the place up. But yeah, that's a topic for another time. But I don't think we know all of office isn't having a problem. This is a few cities, and I really do think that quality of life matters. And cities where quality of life is deteriorating, it's not a shocker that there's a correlation. Those in the markets having the biggest problems. But
Well, look, I agree with you. I also, like I said before, you've got an overabundance of outside pressures on banks saying, "Holy shit, office has changed. People are going to work from home, and that's all they're ever going to do again." It's not true. You know it, I know it, but unless you're somebody who's really in the in the trenches.
Well, you're broaching another subject because we'll talk about the work from
yeah,
home, and
Yeah,
I've got a lot to say about that.
yeah,
yeah,
I think maybe next week we'll dig into that one because I think we'd easy do a whole hour just on that one because
Just
there's
on that. Well, you don't hear my kids in the background. Yeah.
yeah.
Kidding.
Um,
we got one more here. One more piece of always good news that the media is always sharing with
Let's
us.
go.
Yes, the last one is the Applesway Investment Group that blew up. Major syndicator lost more than 3,000 apartments in foreclosures. One of the most biggest commercial real estate blowups in the financial crisis. What my take on this article was what's great about it is it kind of personifies some of the easiest mistakes to avoid in syndications. I mean, and I'll throw them out, but to me, the three big mistakes that this group did is one, adjustable debt, which kind of goes to our whole topic, but they were using
Oh yeah.
adjustable rate, not fixed. They were taking on that interest rate risk, blew up in their face. Another one I just put out is just the sheer volume they were doing. I mean, we were really try to be selective in stuff we're doing. We don't just pick an asset class and try to manufacture as much product as we possibly can. And then the other one I throw out is the founder. Um, no knock on him, but um, he was an IT worker before getting into real estate. No real background before he started
Hold on.
structuring these investments. So I want to, you guys can throw out your other stuff, but the three to me was that jumped out was doing this with adjustable debt, not financially structuring this properly, doing volume over selectivity, and then just not having experience or background in the industry you're operating in. But I'll kind of throw it out there for you guys to.
Well,
Yeah,
I was
Jeff
gonna
raised his
say,
hand first.
damn it.
it's like what is it? Steve, what's his name? The Family Feud, like who slaps down the buzzer quickest?
Oh, we got to see who's on the board.
Yeah, that's right.
All right, go ahead.
I'm gonna go like if we have that 10 topics up there on the Family Feud, I'm gonna go with number one, at least number two is they just didn't underwrite well enough. They didn't look at
No, come on.
but
Come
well,
on. Steve and you and me, we know that the number one there is what his number three was. The guy started in IT and turned around the next day and bought 1,000 apartments with no experience of ever owning real estate before.
agreed. Look, I
So
mean, where I was going to
underwriting
go is,
ties right into that.
well, I mean, that was an easy segue, but the truth is you and I both know that the sheer magnitude of time it takes to underwrite deals, with us who have the experience, much less somebody who doesn't have the experience, you can't just AI your way into underwriting, some of this, it doesn't,
Thinking the same
and
thing.
by the way, you can try. Look, I tried to create a model with AI. It didn't work that way. It
I
basically
spent
told me
6
you're not
hours
good enough.
working on it. Yeah, me too. I spent 6 hours. Oh my God. That's another story for another time.
it kind of reminds me of that great Warren Buffett quote that when the tide goes out, you find out who's been swimming without swimsuits. I
That's
mean,
sure.
while multifamily was doing great and stuff,
I think you mean disintegrating swimsuits at this
yeah,
point.
well, it kind of goes to if you don't know what you're doing and the market's doing great, you don't necessarily notice it. But once you run in some difficulties, you start being able to really quickly tell who knew what they were doing and who was just kind of making it up as they went along.
Yeah.
Well,
I mean,
look, that's what you said no knock, and I agree, no knock. And that's what I go back and circle back to the no experience. And it's not no experience, right? Everyone has some experience to some degree, but going out and accumulating thousands of units at a time, you would know your first thing that you would want to do. This started about 4 years ago. So maybe in that first year, you would potentially look at some floating rate debt. But as far as I'm concerned, I would never look at pure floating rate. They make 5 and 5 where it's fixed for 5 years at a time before it changes. But that's something I learned from doing it for a while. The other side, with Jeff and what he was saying with underwriting, you have to see how those debt payments, those insurance payments, which again, another topic we don't want to discuss or broach today, could impact a property. That's something it sounds like was not done in this case. So when shit hits the fan, there is no safety net. There's no stress test. They just all fall out the bottom. I mean, you read that article, he sent out a report saying, "Oh, everything's going to be fine. Don't worry about it." And then the next report was a special report right before the actual quarterly where he was like, "Sorry, I gave it to the bank. We're in foreclosure." Like, I mean, there's just something there, you get a little bit more time, you do this once or twice, you start with one or two before you buy 10, you learn a few things, and you don't make some of those mistakes and your investors don't pay for it. That's how we came together, is we went through all of that in our own respective careers, and it's not something we would ever do.
Yeah, and let's I'm going to take a step back and just for some of our listeners, just kind of explain duration risk in a really simple way. So let's imagine that we're a retiree on a fixed budget. We got a certain amount of money coming in Social Security. Maybe we got a pension, a certain amount of money coming in, and we're going to buy a house. And we can do that with a fixed interest rate. And we know we've got enough money coming in our pension, our Social Security pay that mortgage. Or we could pay less with an adjustable rate, but the risk would be if interest rates go up, that adjustable could go up and it could potentially go up higher than what our pension or Social Security could cover. And that's essentially what happened here is they got the lower rate of an adjustable, but he took on the risk that those rates could go up higher than his ability to service the debt. And I would say that kind of going back to the experience thing, that's just an obvious thing you don't do. I mean, it's right. It's so obvious. I don't think we'd even consider doing it. It's just kind of crazy to put that kind of risk on when you don't need to with a fixed rate product to try to get that extra few percentage to pad things.
Would you walk into Vegas and bet on 00 on a roulette table and think you're going to win? Or would you know that the house is stacked against you if you do that? That's how I look at an adjustable rate mortgage to a certain degree.
Yeah, you're making an interest rate, but you're basically playing a bond trader. You're basically saying I'm making a bet that I know where interest rates are going to go in the future, and I'm going to try to pocket the spread on the
And those
adjustables versus the
guys, those
fixed.
guys get paid hundreds of millions of dollars a year and have billions of dollars of research behind them. Who do you think is going to know better?
Well, you add to it, and again, no judgment. there was probably some degree of just playing the cap rate, the cap rate side of this as well. I bought this at a 5.5, and cap rates are trending towards threes. Man, I'm going to make a lot of money on my, from 5.5 down to 4, maybe 3.5, somewhere in there when people are buying. Nobody's buying at threes. Nobody's buying at fives anymore. So he probably got compounded with the fact he had the interest rates where they were going the opposite way, and had cap rates going the opposite way, and in his mind probably went, "Oh shit, what do I do now?"
Well, and I think kind of like some of that time. I mean, we started talking about the commercial lending issues, some of the issue commercial banks are having. I mean, this really ties in. And honestly, I'm not a big fan of the Federal Reserve. I think they've botched a lot of things. I think it was a huge mistake taking the Fed funds rate to 0.25%, basically having free money and doing it for a while.
Hey, I liked free money. It was good.
Well, so did these guys, and so did a lot of other people. And I think that's the problem is people started to build business models built around very low interest rates and free money, and they built it around it wasn't going to change. The Fed would keep the spigots on, and that you whether it's FTX or whether it's Applesway or whether it was Silicon Valley Bank having a lot of short duration treasuries and not having enough longer duration that they got hit with this
Zach
too.
Preminger? That's how
Why you got short duration treasuries?
I did.
No, I'm sorry. Yeah. No, I flipped that. Sorry. Silicon Valley Bank had too much in the way of long duration, not enough short. So, when the rates started going up, they were still holding that longer duration paper with the lower rates. But yeah, I think, all this stuff's interrelated. And you had a lot of business models, whether it was Silicon Valley Bank or whether it was Applesway, or whether it was FTX or, a lot of players that were really built their business model around cheap money, low interest rates. And we're just seeing some of those players that didn't structure things properly blown up.
That's what happened to me, and that's what I learned the hard way. Is I used adjustable on my first property that I purchased, rental, and got a run up and lost it. Well, I didn't lose it. I ended up selling it, but I didn't sell it for what I thought I was going to sell it for.
You mean you didn't buy $100,000 property and sell it for $2.5 million?
Well, I mean, I have done that, but it was not in residential real estate. So,
well, that's part of. I mean, that also gets back to our point about experience. I mean, part of experience is you've been doing this for a while. Earlier in your career, you might have made one or two mistakes and learned from them. And you've certainly, if you've been doing it for a while, you've seen plenty of other people make mistakes, and had the opportunity to learn from their mistakes too.
You mean like those too good to be true deals with like 40% return on investment?
Oh God, love those. I'm still looking for one of those. You guys ever find one, and I'll send my my money to the prince overseas.
I was told they're all in development.
Great.
Yeah, a few less of those nowadays, as we're seeing them blow up. Anyhow, that's what I've got in terms of news headlines for today. We'll get together, have a few drinks, and talk some other headlines soon. I'm sure it'll be more uplifting, bright news stories from the media we have to talk about.